Yeah, hello everybody. Global economics, and today I will, yeah, go further on with this short overview with the example of the economic performance of Germany, because you should do in your term papers a general economic overview of some country. I think you chose UK, Luxembourg also. I remember Brazil, and so on. So, where's my mouse? There it is. So, in general, you should have a look at the main macroeconomics indicators, inflation, unemployment, and especially economic growth. And about economic growth and also long-run economic growth, we talked the last time. And in general, we talked about this part here, because in general we see from the data that an economy is doing some business cycle around a long-term trend. And I think therefore I also just reopen the Excel file we did last time, and there especially I showed you as a first try in order to estimate this long-term trend from historical data. We just took the long-term average growth rate for the time period here, starting from German reunification in 1991 until now. And then I also said that always one has to be careful and one has to know what you are doing in order to get, so to speak, a good result. And then I calculated the long-term growth rates from reunification just until Q4 2019, just before the beginning of the Corona pandemic. And as maybe you all know, that there was a very large turmoil economically during Corona times. And although if we then just go on only one quarter, we see, because this turmoil during Corona times was that large, that we had a time period of roughly 30 years, 35 years, and then moving just 1, 2, 3 quarters on during this heavy crisis, the long-term average growth rate just dramatically changes because of this crisis. So we went in here with an annualized growth rate of roughly 1.4, 1.5%. This is not very surprising for a so-called old economy, that you have roughly average growth rates of 1.52%. But then Corona happened, first quarter, okay, it dropped a little bit, but then in the second quarter, this was then, so to speak, the first wave of Corona. We had the first shutdown in Germany and almost all overall in the whole Europe. There you see that the average growth rate dropped by roughly 0.5 percentage points. And if you think of a long-term investment or something like this, a difference of 0.5 percentage points over 5, 10 years, this dramatically changes the outcome. Maybe in order that you see this, we just make an example. Let's take what 0.5 percentage points means. We make an investment of, let's say, 1,000 euros, and then with a growth rate of 1.5 1%. And let's take 10 years. And this would then mean after 10 years, if you have a yield of 1.5%, we would have an outcome of 1000 times 1 times the growth factor, 1 plus growth rate up to the power of 10. So after 10 years, 1160. And now if we just change this to 1%, or let's take this just down that we can compare this. And if we take the relative difference here, then this over this, minus 1. Then this would, and let's take it in percentage. So, and this would be that after 10 years, you really have a difference of 5% in the outcome. And if you look at it, having additional 160 euros is quite a large difference compared to have only an additional 100 euros. So in absolute terms, it's even 1/3 what you have here in the difference. And therefore, you have to really carefully choose your time period if you are calculating the average growth rate, if there is a crisis within your time period. Okay, and then for Germany, you saw that in general, we could say that the average growth rate, dropped unfortunately during or after, in the aftermath of the corona crisis. And if we look at the diagram, then you see it also here that in general we have an increasing trend, and since corona the economic performance of Germany is not that well, because we have here a sidewise trend in GDP of Germany. Okay, this, and then we went on, and I talked a little bit about potential output, because this is what we want to estimate with this long-term trend. And then I also showed, and maybe if we have here some international guests, maybe we can make a little example. I went through this in my macro course. I said here this is more or less the business cycle of Germany since 1970. And then we could go through the numbers here, 1, 2, 3, 4, 5, 6, 7. You can also participate in from the internet via the chat, and maybe you could name what we see here. So these are the quarterly growth rates of Germany, and you see here that more or less always when we are a longer part at very low growth rates, or even the economy is shrinking, then maybe you can help me that we identify some event which happened during these times. And this is not only special for Germany, but also special, or not special, these are events with a global impact which happened in these times, where you see a quite poor performance of Germany. And if we start, and this has unfortunately also a dependence on the actual situation. If we start in the 1970s, so 1972, 1973, which historical event was the reason that the economic performance of Germany and, of course, almost in the whole world was quite poor? Yeah? Pardon? The wall, this later. This we find here also, but we are in the 1970s. What happened there? Oil crisis. Yes, this is the first oil crisis. So this was just the time when, in the 1960s, the OPEC has formed, because before that, more or less, the United States and especially UK, they were the power in the Middle East, and then these countries, Saudi Arabia, Iraq, Iran, and so on, they formed their own union, the OPEC, and then they just said, well, we stop exporting the still most important good in the world, just oil. And this then meant, especially for Germany, that yeah, we stopped driving cars at Sundays. So all our streets, um, there were no cars in this time, and this was the decision of the OPEC. And in the end of the 1970s, 79, 1980, what happened then? Because this was then the second oil crisis. And what was the reason for the second oil crisis? 1979. And from this 1979 event, this is still one of the main reasons of the heavy problems we have in the Middle East. What happened in 1979? And this, of course, had a large economic impact. This was, so to speak, the change of the government in Iran, and Ayatollah Khomeini came into power. And then, of course, what was the first thing he started? The first Iran-Iraq war. And Iran-Iraq, two of the main oil producers, well, this, of course, had then also a bad impact on the economy in the world. Then number 3, here you are. This is German reunification. Fortunately, this lasted only roughly 1 year, but then also, unfortunately, the economic growth in the aftermath was not that large as expected in Germany. Well, then let's go. And this is also independence with our actual situation today in 2001, 2002. What happened in 2001 from an economic perspective? And then there was an additional very important event, which really dropped down the economy even more. So this was the so-called dot-com crisis, when the stock markets went really down the first time. In the years before, we had a huge growth through new digital, through the increasing digital economy. And This was also then, I think, Black Wednesday and not a Black Friday. And of course, we had 9/11 in 2001. Number 5th, 2008, 2009. Pardon? Yeah. Crisis? Which crisis? Global financial crisis. Yeah. And of course, here you see it. Plus 15, minus 15. The economy more or less only followed the waves of the pandemic. So this is then, of course, Corona. And then, of course, in the end, we have this crazy guy from Russia. And this is Ukraine war. And not very surprisingly, all these events we see, of course, also in economic data. And the for you, you are writing your term paper. If you are analyzing these time series, you will also see some events and maybe also some special events depending on your country in the economic data. Okay, but then economic growth we had already. I will go through other parameters and I will go also to the internet in order to download the data, because you should not only copy and paste something from some PDF file from the internet. You should go for the data by your own. So die studies, this is the German Statistical Office. Let's see if it's working. Yes, it is working. And here you see, I think this one, is it? There's no download, or, oh, there it is. It's up. And something similar you will find for your countries. If you go, for example, to the Statistical Office of France, of UK, or somewhere else, and here this is GDP, and then you see, for example, here the nominal GDP for Germany on the yearly basis. Okay, let's just save this, and I will upload this as an example also for you. So this was GDP. Then let's go on. Well, inflation. Not very surprisingly, the inflation data you get from the central bank. Statistics, see you, and you will find at your country some button data or something else. And here is the consumer price index. Let's take more interesting is the monthly. This was yearly. And this is the monthly data. Let's download this and then let's have a look. what we see. So this is the index of the consumer price index, and of course we can have a look at the index of a consumer price index, but much more common is that we just have a look on the inflation rate. And question, if we have the index, how do we obtain the inflation rate? Maybe you have within the classroom an idea, and also the internet. What do I have to do with my data? What is inflation? This I have to say we have done in my macro course when we talked about price developments. I don't know, what is inflation rate in Hungary right now? Do you know? Yes, I think also. Let's see if we find it. Has anybody Hungary as a country? I don't know. Inflation, trading economics, 4.1. This is quite high. Or August dropped down to 3.4. Okay, but inflation rate in Germany in 1991 was not 60% because this is the index. So inflation is just the change of the index, but if we look at inflation, then we do not compare. If we look at a monthly basis, we do not compare the index of compared to the months before, but we always compare the index on a yearly part. So we are comparing them here 1992 January with the index of January in 1991. So, and the relative change is then 63.9 over 60.5, and this would be then the inflation factor. So we have to subtract 1, and this is the inflation rate of Germany. Let's take percent. And the nice thing is now that we can just copy this formula down to September 2024. Here we are. Because we want to have a look at the inflation rate. The inflation rate is just the common indicator with which you are measuring the general price development in an economy. And yeah, now we want to have a look at this inflation rate, and maybe we can see also something what historically has happened as we were talking about the economic cycle, looking at the growth rate. So, and then you can choose here the diagram, and this is the index. This we don't want to see, but the inflation rate. And then you can change this. Oops, and I have to go here with percent. Yeah, let's take this and go into my slides. Well, and as my guys should start their analysis beginning with the global financial crisis, we start that we look at roughly 2008. And what do you see here is that prices went down within the global economic crisis. And is this plausible if you think about what the economy is doing within a crisis? So we came from a quite high level in summer 2008, and then all the bad things to the banking, especially the banking sector, happened throughout the world. And there you see, we came in Germany from roughly 3%, and we moved even to slight deflation, so that prices were shrinking. Well, since we have here the global financial crisis, as we saw in the economic cycle, the economic performance were bad. And what does it mean? Well, demand is falling. Yes, but we just started it then. At first, we had this drop down, and you see it, it is until the midst of summer 2009. And yeah, let's talk about then what then happened after the intervention of the central banks, not only in Europe but in the whole world. What then happened? But what does it mean if demand is falling? If you look at a market equilibrium where you have um, demand and supply, well, this is then your price equilibrium price level. And if demand is falling, this means that your demand curve is shifting to the left side. Well, and not very surprisingly, prices are falling. Or if you think of, well, if there are not that many customers moving into your store, you still want to sell your things. What are you doing? Maybe you try to lower your prices. So this is not very surprising that within a crisis we also see a drop. But what is then maybe a little bit more surprising is, well, the intervention of the central banks putting money into the economy. This more or less worked, especially quite good for Germany. But then we had actually also a quite good period during these times. And this is a little bit of a puzzle that during these times the prices not really came up. Because if you think of it, this was also the time where interest rates were roughly 0%. And yeah, during these times, all central banks throughout the world, they really tried to push the economy, but it doesn't work in that way that we hoped that it worked. And this is somehow a little puzzle. And for my guys, maybe um, you can yeah, discuss within this period quantity theory of money. And if you remember your macroeconomics lecture, this means money amount times velocity of money. So this is maybe every euro which is circulating in the economy with euros, with the money. We are paying our goods and services. Well, and quantity theory of money just said all this money is needed to pay what we are producing. What are we producing? This is why. This is abbreviation for GDP, for gross domestic product. Well, we are paying in euro, so multiplied by prices. So this is money, velocity of money, how often we spend the same euro during some time period. Prices and real GDP. Well, and the expectation is during these times, the balance sheets of the central banks throughout the world, they doubled, they tripled during these times. So more or less during these times, let's say we are doubling our money, velocity of money. This is, also it can change in time, but it depends in general on the framework. So in the 1970s, we just paid cash. Then we could take our credit cards, our banking cards. This increased the velocity of money. And right now, we can also pay we have digital payments. This also increases the velocity of money, but this takes long time because this is the general long-term framework when velocity of money changes. So if we look only at half a year or 2 years, we more or less can say, well, velocity of money is more or less constant. And also we have seen, especially in industrial countries, so-called old economies, GDP is changing roughly around 0.5, 1.5%. And if we compare this to a doubling of the money base, increasing the balance sheet of the central banks within half a year that it doubles, then from this theory, we would expect if this is more or less constant, this is more or less constant in a short-term period, that we would have a one-to-one matching of prices and money increase. But this is still puzzling the economists around the world. It doesn't happen. Prices were more or less flat around 1 or 2% in the developed countries throughout the world. Well, and then Corona started again, dropped down. Again, we can argue from equilibrium. Well, we were not allowed anymore to buy something more or less during the shutdowns. And then we have this large increase here. And this you see here, it doesn't only started with the Ukraine war, it even started half a year before Ukraine war. Because Ukraine war, of course, due to the stop of the gas exports from Russia to the European Union, this of course increased dramatically energy prices, and this of course then pushed inflation overall. But the increase of inflation up to 4 or 5% started half a year before. And maybe the explanation is that we have something like a time lag from this argumentation theory, quantity theory of money, that during these more or less 10 years, we had, maybe very much power within our system, but which didn't explode in prices. And then there was so much power that after the turmoil of the Corona crisis, also during the Corona crisis, we had more or less to save. many people increased their savings rates from in Germany roughly 10% to almost 20% because we weren't allowed to spend our money. And this also then increased demand. We had very much money in the system, and this all together then had the result that prices really started to increase, and then here additionally Ukraine war with the energy crisis. Yeah, okay. And I think in your countries you will find some similar pattern as we see it here for Germany. Okay, then let's go to the next one. Unemployment. Well, this is quite special for Germany. The numbers you find also at the central bank. This is always a good choice if you want to find economic data of a country. Then statistical office and of course also the central bank. I think this is also monthly data. Let's see. No, this is quarterly data. Yearly data. Don't we have monthly data here? This is a monthly. No. No. This is some other numbers. This one? No. Well, then let's take the quarterly data. Somewhere are also the monthly data. This I also wanted to save. This was inflation. This we can close. This is unemployment. Oops. And now here. Let's see how this looked like. Well, let's start then at yep. So no. So also let's start in the economic crisis. Here, and what we see here, this is quite surprising for Germany because we know here we have the global financial crisis. And somebody of you has also some other countries from Europe. We can say more or less in 2012-13 we had the euro crisis, the turmoil of especially Greece. And this one is Corona. And what is quite surprising for Germany, that although we had here a very large crisis, this hasn't had that a large impact for Germany, because why? Germany was performing quite good in an economic way, but we have a general monetary policy, and interest rates dropped down to by the ECB to 0%. And within an economy which is performing quite good, you would not lower the interest rates, because what is lowering interest rates are doing, this makes credits less expensive, and this is even additionally pushing the economy. But since we have the monetary union in Europe, and we have a general monetary policy for all members, there were many members, Italy, Spain, Greece, of course, and so on, which were not performing very well during these times, and therefore we have this very low interest rates, which was from an economic perspective too low for Germany during these times. So, but also here during Corona, we see more or less no increase and even a decrease during these times of unemployment. And this is very surprising, especially if we look here at the global financial crisis. There we had a drop down of 5% of GDP in Germany. Do you know does now somebody of you know why, especially in these two crises here, we do not see a significant rise in unemployment? Yes, yes. And this was more or less also a German invention in the global financial crisis, and almost all countries in especially Europe, United States not that much, they also chose these instrument, and this is short-term work. What you meant that they just dropped, I think this you meant that they dropped down to 50%, or even they could go home and they still were paid. And if you look then at the short-term number, at the short-term worker number during the global financial crisis and especially in Corona, then here we had 1.5 million people in short-term work, and here during the shutdowns it was 6 million people in short-term work. So, and yeah, this of course you also have to know, because if you look only at the official statistics, then you say, oh wow, two dramatic economic crises, and we do not see anything within the unemployment data. Well, behind this is we more or less, yeah, defined unemployment as not rising, because we just said, well, you are not fired, we just pay you from the government during these times. Okay, but then of course this looks not so nice for Germany, that after a more or less falling trend, knowing these two short-term worker periods, but in general we had in Germany a falling trend in unemployment over almost 10 years, that now unemployment rate is starting to increase, although if you go around here in Germany, you at almost every store, or if you're driving with a car or with a bus to our cities, you always see, well, please come to me, I want to hire you, we need you to work. But nevertheless, unemployment is increasing, and yeah, my explanation from a macro perspective is that what we see here is that in a dramatic way, we need workers, but now we see in many parts that the people have not the education we need, and therefore they are not hired right now. And this, maybe you are young now, you should also keep in mind, because you are educating yourself right now. So that you are educating yourself for the right things which are needed tomorrow. And of course, what does it mean? You have to have some competences in digital economy, digital competences, of course, because this will, of course, dramatically change our labor market during the next years. Okay, next one. Export imports. This I think we find already in. Oh, where is my data? There. And the unemployment I also want to save. This is this one. Unemployment. Oops. Exports and imports. This we find here. Let's take here now the yearly data. And let's take a new one. I think this started in 1991. Yep. Trade, and this is billion euros. So please, in your term papers, be also careful that you write at the exits what I am seeing. So these are not apples or something like this. These are billion euros. And we can also calculate another parameter. This is the openness. For this we need also GDP. Mhm. And openness is defined as how much a country is trading relative to their overall economic performance. So what we are then doing is just summing up exports and imports and dividing this by GDP. Because then we see how much we are relatively trading in our country due to our whole production. So this plus this over this one. Oops, this is a bit, oh, there I forgot the brackets. And also in percent. And let's also create a diagram. And this is then the openness of an economy. Yeah, and what we more or less see here for Germany is, especially if we look here, if we now start in this time at 2000, at roughly 2000, then here in Germany we had roughly exports meeting imports. But still, Germany is also for these times known as one of the main exporters throughout the whole world. So in absolute terms, Germany is exporting the second most goods and services in the world. First one is now China, and if we go back in the 90s, then China was economically had a size of roughly Italy. Now they are the second largest economy in the world after 20 years. Um, so during these times, we were the largest exporter in the world. And the reason why imports are during these times, although we are the largest exporter, has met roughly exports, was that we really need many, many goods from abroad in order to build up the East Germany part of the reunification. And then, more or less, we can say this was the time when China stepped in. More or less, this was the economic starting point of globalization. And what we see there is then now exports even more increased than imports, and we have always an export, larger exports than imports. And the difference here is you see it for Germany, roughly 100 to 200 billion euros. And this is more or less the largest saldo in the world, the difference between exports and imports. And if you have a look at your countries, there, of course, you will find different patterns. You even will find that imports are larger than exports. And maybe you have then an interpretation for this, because why we are not exporting relatively that much. And what is also interesting to look at for the economic performance is these openness, is exports plus imports over GDP. And there you see that this also increased for Germany, and now we are roughly at 80%. And if you compare this internationally, you find that this is the largest number throughout the 20th largest, economically largest countries in the world. So to speak, one can say that Germany is relatively the largest trader in the world. Well, this helped us very often, especially in the aftermath of the global financial crisis, because more or less during this time here, Um, the global economy, so to speak, just stopped, but fortunately stopped only for 3 or 6 months. And then also the demand more or less came back, especially from the emerging markets. And who had the goods for the emerging markets for building up their industry? This was in a quite large way Germany during these times. So this was uh, um, a reason for our good performance during these 10 years between global financial crisis and corona crisis. But what we see now here, if we look at the end, that we have this side trend of exports, especially for Germany. And here, maybe you find for your country also monthly data of the trading development. And then for almost all developed countries, you find the trade is not increasing that much anymore. Well, and the reason is, I think, quite clear. The global political situation. We have this clash, especially between China and the United States. And what we see here is what we now calling decoupling or de-risking. Especially if we look to Europe, then we ask ourselves, should we still take all the electronics? Should we take Huawei or other cell phone companies from China? Because there is maybe a security risk if we use these phones in the future. And this, of course, we also see especially in the trade data. So then let's take another. Where we are here. This one and this one. Exchange rate. Okay. This for the most European countries is only one exchange rate because we have one money, the euro, in 19 countries. So in general, the most important currency in the world is still the US dollar. So let's have a look at the exchange rate of the US dollar. Download this too. And okay, euro to dollar. And all the dots you have to delete. Oh, at first this has to be gone and up. And now we can plot the data. Up. This was my recording. Oh, here we are. And yeah, and what we see here, exchange rate euro dollar, that more or less we are right now there where we started in 1999 when we have introduced the euro. It is roughly the same. Well, This is just by chance that it is right now. But in general, you see, starting from the financial crisis, we have more or less a trend of depreciation of the euro versus the US dollar. So, trend of depreciation of euro versus dollar. So in 2007, when you have traveled to New York and you want to buy some jeans and you have euros, then for €1 you got $1.60. And if you now travel to the United States and you want to buy a jeans, then you have to change your euro for roughly, I think right now it's 1.05. So a depreciation of almost 60%. Well, this at the first look, this seems dramatically, but if you look in general in historical data, and even for 100 years, if you have a free floating system between the currencies, then plus minus 20, 30% or so also within 1 year is not very surprising. This you always more or less find in a free floating system. But here I think this is interesting that we have this general trend, and this general trend we maybe can also interpret in general in an economic way. If we look at the general performance of the European Monetary Union as an aggregate and to the United States as an economic aggregate, then also we see that the economic performance through the last 15 years of the United States was a little bit better than these compared to the European Monetary Union. And then it is also not very surprising that your currency is depreciating if you are not performing that good as your trading partner. And yeah, maybe when you are doing your term paper, you can also have a look at the exchange rate with the main trading partner, not only with the US dollar. So we have here some guy from Hungary. Then it would be, of course, also interesting if you take the forint versus the euro and not only the forint versus the the US dollar. Or there is somebody who has Japan, I think, as a country. There, the main trading partner is not very surprisingly China. So looking at the yen versus the renminbi. But then you will find something interesting because the Chinese government more or less couple their currency on the US dollar. So you will find a quite similar pattern between the yen and US dollar and the yen and the Chinese currency. Okay, 9:30. Then that's it for today. And next time, what else did I had? Interest rates, key interest rates, and government debt and fiscal deficit. We will do then on Monday. Thank you very much for today.